PEG, price-earnings to growth ratio. The price-earnings to growth ratio, PEG, is an extension of the profit-to-earnings ratio that takes into consideration growth rates. The following formula is used. Earnings growth rate, price-to-earnings ratio. The earnings growth rate is an estimate of the company's expected earnings growth over a certain time period. It is expressed as a percentage. Assume we expect 10% annual growth for our aforementioned firm over the following 5 years. We divide the price-to-earnings ratio, 2, by 10 to get a ratio of 0.2. That ratio suggests that the firm is a smart investment since it is significantly undervalued when we consider future growth. In general, any company with a ratio of less than 1 is undervalued. Any of the aforementioned might be overvalued. Many people prefer the PEG ratio over the P/E ratio because it takes into account a significant variable that the P/E ratio does not. Cryptocurrencies and fundamental analysis. The aforementioned measurements do not apply to cryptocurrency. Instead, you might consider other elements to determine the profitability of a project. A few indicators utilized by cryptocurrency traders are included in the following section. NVT, network value to transactions, ratio. The NVT ratio, sometimes referred to as the P/E ratio of cryptocurrency markets, is quickly becoming a crypto FA standard. It is possible to compute it as follows. Daily transaction volume, network value. NVT seeks to assess the value of a particular network based on the value of transactions it conducts. Suppose that you have two projects. Coin A and Coin B both have a $1 million market capitalization. However, Coin A has a daily transaction volume of $50,000, whilst Coin B has a transaction volume of $10,000. Coin A has an NVT ratio of 20, whereas Coin B has an NVT ratio of 100. Assets with lower NVT ratios are often regarded undervalued, whereas those with greater ratios may be deemed overvalued. These advantages alone indicate that Coin A is undervalued in comparison to Coin B. Active addresses. Some people use the number of active addresses on a network to determine how much it is utilized. While not a trustworthy independent indication, the measure may be manipulated. It can give information about network activity. You should consider this while determining the genuine value of a digital item. Mining break-even price ratio. The price-to-mining break-even ratio is a statistic for determining the worth of proof-of-work coins, which are mined by network members. It considers the expenses connected with this procedure, including the price of power and hardware. Coin market value, cost of mining a coin. The price-to-mining break-even ratio might indicate a lot about a blockchain network's present status. The break-even point is the cost of mining a currency. For example, if it is $10,000, miners will generally spend $10,000 to make a new unit. Assume Coin A is worth $5,000 and Coin B is worth $20,000, with both having a break-even price of $10,000. Coin A will have a ratio of 0.5, whereas Coin B will have a ratio of 2. Because currency A's ratio is less than 1, it indicates that miners are mining the coin at a loss. Mining Coin B is lucrative since you may anticipate to earn $20,000 for every $10,000 spent mining. Because of the incentives, you may expect the ratio to move toward 1 over time. Those mining at a loss for Coin A would most likely exit the network until the price rose. Coin B offers an appealing reward, thus you'd expect more miners to join in order to take advantage of it until it becomes unprofitable. The usefulness of this indicator is debatable. Still, it offers you an understanding of mining economics, which you might consider when evaluating a digital asset. White paper, team, and plan. The most common approach for determining the value of cryptocurrencies and tokens requires some good old-fashioned project research. You may learn about a project's aims, use cases, and technologies by reading a white paper. Team members' track records provide insight into their capacity to construct and expand the product. Finally, a roadmap indicates whether or not the project is on track. It may be augmented with further research to estimate the project's chances of meeting its milestones. The benefits and drawbacks of fundamental analysis. Benefits of fundamental analysis. Fundamental analysis is a strong tool for evaluating firms that technical analysis just cannot match. Studying a variety of qualitative and quantitative elements is a critical beginning point for each transaction for investors all over the globe. Fundamental analysis is simple to do since it depends on tried and true procedures and widely accessible company data. This is true, at least in conventional markets. Indeed, when it comes to cryptocurrency, which is still a young business, data is not always readily accessible, and the high correlation between assets suggests that FA may not be as effective. When done correctly, it provides a foundation for identifying stocks that are currently undervalued but are poised to rise in value over time. Top investors such as Warren Buffett and Benjamin Graham have often proved that doing extensive company analysis in this way can deliver significant rewards. The disadvantages of fundamental analysis. Fundamental analysis is simple, but excellent fundamental analysis is difficult. Determining a stock's intrinsic value is a time-consuming procedure that needs much more effort than just entering figures into a formula. Many variables must be considered, and the learning curve for doing so efficiently might be severe. Furthermore, it is better suited to long-term transactions than short-term trades. This form of analysis also ignores significant market dynamics and trends that technical analysis might detect. According to economist John Maynard Keynes, the market can stay irrational longer than you can remain solvent. Stocks that seem to be undervalued, by all metrics, are not certain to rise in value in the future. Final thoughts. Fundamental analysis is a well-established discipline that many successful traders swear by. By honing a strategy, investors may not only learn to better assess the real value of stocks, cryptocurrencies, and other assets, but also get a better understanding of companies and sectors as a whole. Fundamental analysis, when combined with technical analysis, may provide traders and investors with a comprehensive knowledge of which assets and companies they can benefit from. Many people in both the traditional and cryptocurrency markets like the mix of FA and TA. However, given the nascency of the crypto markets, you should be aware that FA may not be as effective. Always do your own research and have a sound risk management strategy in place. Thank you for watching and don't forget to watch part 1.